you will, our framework for our investment strategy for 2025. And these were in order, we expected corporate earnings to increase in 2025 by some 12 to 14%. We thought dividends would increase apace because of that increase in earnings. We thought company management teams would work to maintain and or improve profit margins. We thought greater investment in the use of artificial intelligence. We thought interest rates were slated to decline by perhaps another 50 basis points. Unemployment, we thought, would range somewhere between 4 and 5%. We thought regulations would be more accommodative for U.S. businesses. We thought previous tax cuts would be maintained and some new ones introduced. We thought tariff use would rise. And we thought deficits and government debt would become more of a focus for investor attention. And I would say we thought that all these together, or some mixture of them, if you would lead to a pretty healthy market in 2025. And I think we can say that luckily, generally, a lot of those planks in our framework did come to pass, and investors reacted accordingly, and we had a strong market in the United States. The S&P was up some 16%, but we had even better markets overseas as companies performed extremely well. And as a number of investors decided that it had been a long time since international markets outperformed the US marketplace. And investors thought that they had just gotten to be too cheap. And so a lot of investors decided to pour money into a number of international markets, which meant that they outperformed. They were some of the top performers in the world, and we'll get to some of that later on. As far as 2026 is concerned, as we look out to this year now, we're taking about 8 of our 10 from last year and reusing them. Sorry to be boring, but we thought that really they are still very pertinent, such as corporate earnings are expected to rise some 12 to 14%. Dividends are expected to increase a like amount. Company management teams are continuing to work to maintain or improve profit margins, and we're seeing this with a greater utilization of AI. There continues to be huge investment in artificial intelligence and increasing use of artificial intelligence. We think interest rates are still slated to go down somewhere between 25 and 50 basis points this year. Unemployment, we think, is still going to range between 4 and 5%. We're currently at 4.6%. We continue to believe that the regulatory environment is going to be very accommodative. It's a hallmark of this current administration to strip out a lot of regulations, and that is going to have a very beneficial effect on corporate costs. In fact, I think, Richard, you pointed out a number earlier today, was something like total cost going down by 600 billion, and of that, the regulatory was something like 400 billion.
It was over 300 that they had put a dollar value to corporate America on the deregulation. and it
Yeah.
was a substantial number, over 300 million,
Yeah.
300 billion.
So that's going to have a continued beneficial effect. We still think government deficits and debts are going to be a focus of investor attention. And in fact, there was an instance, if you will, in Japan just a couple of days ago, maybe it was about a week ago, where the Japanese bond market sold off quite sharply, and yields in Japan rose some 25 basis points. Now, that may not sound like a lot of movement, but for a bond market, that's a lot of movement in a 24-hour period of time. In fact, that's a two standard deviation movement in yields on Japanese bonds. And that was a reaction to the current prime minister who's trying to call snap elections. Um, she has decided that she's going to, in a way, to sort of further her political prospects to get reelected. She's going to eliminate taxes on food, which is obviously a very popular subject. And the bond markets in Japan reacted badly to that because all that's going to do is enlarge the Japanese deficit. And so there have been several commentators who have said, you know, Japan is sending us a warning signal because their economy is even more levered than the US economy. And the Japanese bond market is saying to the government there, you've got to get your fiscal house in order, or we're going to demand more return, higher interest rates on our bonds if we're going to buy Japanese bonds. This is exactly the same message that the US bond market participants are sending to our own government. We don't think two of the planks of last year's investment strategy, we don't think are going to be repeated again. Previous tax cuts, there aren't going to be any new tax cuts. We think that that boat sailed. Congress is too occupied with other things, and it's not going to be tax cuts. And tariff use may rise. Well, we certainly didn't expect the most recent messages out of our president with regard to Greenland and the use of tariffs to get something else accomplished. We thought we had had all the negotiations that were to be had with our major trading partners with regard to tariffs, and we thought that subject had been put to bed. Hopefully, it has been put to bed. Hopefully, that the administration is going to turn away from further utilization of tariffs. And also, we've got to remember that the Supreme Court is about to rule on the legality of these tariffs. People were expecting the ruling last week. It didn't happen. They were expecting the ruling this week. It looks like it's not going to happen this week either, according to news that came across the wires earlier today. So we're not exactly sure when it's going to happen, but it could well be, and the current betting is such that the Supreme Court is going to rule that the tariffs are illegal. And thus the administration is going to have to figure out another way of replicating that if they can at all. But we still think that there's enough reason here to be quite hopeful with regard to increase in asset pricing if all these various planks lay down again for our strategy as we are thinking they're going to.
Let me take it for a minute, Peter, give you a chance to catch your breath. The last year was surprising to a lot of investment professionals that everything went as smoothly and that the stock market was as resilient, especially the US stock market, was as resilient as it was. And many explain it by that the positives offset the negatives. The positives included very accommodative monetary policy, because there were three cuts in interest rates during the year, 75 basis points, which was helpful. There was also the passage of the Big Beautiful Bill, which, although some of the provisions aren't coming in to full force until 2026, there were still provisions that helped 2025 as well. So both monetary and fiscal policy were very accommodative and helped keep aggregate demand up. That, of course, buoyed the stock market. And because when you have a stock market that has robust returns, the wealth effect kicks in and it reinforces decisions to spend. So American consumers were spending last year despite their gloomy dispositions. And last, on the positive note, was the very high level of euphoria over artificial intelligence. Although there's probably some suspicion that the hype is a little overstated, the euphoria that we experienced in the second, especially in the second half of last year, was not overstated at all. There were discussions about different corporations borrowing massive amounts of money to build data centers to get themselves competitive so that they could truly reach their potential using AI or providing AI. So those three very, very positives offset the negatives, most of which were related to the administration's, I won't call it haphazard, but it was a somewhat unpredictable uh, geopolitical and macroeconomic policies. Had the market, the um, analysts a little bit on edge as far as what to predict going forward. As Peter's commentary is called, it's awfully hard to predict, especially about the future, which is a Yogi Berra quote from I think the 60s or the 70s. But the other negative impact was the tariffs themselves. We saw what the original reception to the tariffs was back in April when the so-called Liberation Day tariffs came into place and the market fell out of bed. I think the drop was very close to 20% in the US market, and international markets were pulled down as well, not quite as much as that. But the tariffs definitely had a negative effect on the stock markets, US and global, and the bond market as well. And I think President Trump realized that he had to back off a little bit. And I remember when the market was down 19%, President Trump came in and I think posted on his Truth Social that it was okay to buy again because he was prepared to back off from some of those tariffs, especially the tariffs on China. So sort of as a summary of 2025, the accommodative monetary and fiscal policies combined with the buoyant stock market, combined with the AI euphoria, was enough to offset the negativity of the uncertainty as well as the negative impact of the tariffs. So enter 2026. What Peter and I have talked about is breaking that down into its three components. What happens to the economy depends on what happens to consumption, plus investment, plus government spending. For anybody who took Economics 101, gross national product, gross domestic product consists of the sum of those three with some adjustments, but the sum of consumption plus investment plus government spending. So, Peter, I know your commentary spent a good bit of the early part of it talking about the health of the consumer. Is the consumer, despite his gloomy attitude that shows up in the consumer confidence, is he ready to continue to spend? He or she ready to spend in 26 the way they were in 25?
It would seem so, Richard. And so, Christine, if you could go to chart one, please. And this is a chart that we have used in the past. So you all will have seen this if you've been reading the commentaries. And this is the consumer's balance sheet. So the US consumer represents 70% of US GDP. So it is the gorilla in the cage with regard to how well the American economy is going to go. And on the left-hand side of this chart, you can see the consumer's balance sheet. Now, this is as of the second quarter of 2025. This is the latest data that we have, but it wouldn't have changed dramatically since then. So you can see on the left-hand side, total assets of $197 trillion. And you see total liabilities to the right of $21 trillion. So that the net worth of the American consumer is $176.3 trillion. So the American consumer is way underlevered. And you can see the makeup of the assets. Financial assets make up the largest share. Pension funds, which are typically in financial assets, is the second. You've got homes, or excuse me, homes are the second. And then you've got other tangibles and you've got deposits. Well, we all know what happened with the stock market last year. We've just been discussing it. So fully the bottom half of that chart had quite a good year last year. Home prices also, I dare say, didn't go down. So the American consumer, again, their assets, even since this snapshot was taken, assets appreciated in value. If you go to the top right chart, you can take a look at household debt service. You can say, oh, okay, fine, the assets look very strong, or the net worth looks quite strong, but is the American consumer able to service the debt that they've got? And you can see here that debt service, as of the third quarter of 2025, was only 11.3% of disposable personal income. And it's near its lows, which were recorded in 2021, 2022. So the American consumer writ large, and I'm just talking about the whole population, not discrete segments of it, but writ large, is well able to handle the debt service on the debts that they have. And as you can see from the balance sheet, they really don't have much in the way of debt. And then in the bottom right, you can take a look at, well, how about delinquencies on auto loans or credit cards or mortgages? And you can see again, these are the green and the blue lines. You can see that the delinquency rate is quite low. Now, the one area of loans where there is some distress, and that's in student loans. And, we don't know if that's because it's economic distress or somebody just making some sort of a statement or about something, but student loan delinquencies have gone up. So again, the consumer, which is the most important part of US GDP, and quite frankly, is one of the strongest legs of a four-legged stool called our US economy. It's doing very well. So let's take why don't we go to chart number 2 then, Chrissy. And here we're taking a look at the consumer's emotional balance sheet, if you will. It may sound a little odd, but we've seen financially the consumer is in very good shape. But emotionally, the consumer has expressed in surveys some real distress. And this is not unusual for the American consumer. We've pointed this out in the past. And in fact, when consumer sentiment is measured by the University of Michigan's Consumer Sentiment Index, which this is, gets down to where it was recently, as you can see in September of 2025, it got that, this is on the far right-hand side of this chart, it got down to around 55.1. So when it gets into a range, when consumer sentiment gets into a range of between 50 and 60, that's 2 standard deviations negative, if you will, to the standard, to the average. And curiously enough, and this has happened on several occasions, you look back to the far left, February of 1975, or May of 1980, a little bit further to the right, or November of 2008, or August of 2000, all these low points that are in that range, the stock market has had quite a substantial rally. And sociologists are not quite sure why that happens, but it seems to be pretty consistent. And maybe it's because, people figure it can't get any worse. So they're just going to go out and spend money. And in so doing, they end up supporting the economy. So unemployment in this country, as was mentioned earlier, is running about 4.6% right now. And so that is historically relatively on the low side. I mean, it's been lower, it's been in the threes, but it's also been a lot higher. It's been in the, good Lord, I remember quite a few years ago, unemployment got up to, I think, 10%. So most economists would say that where the US economy is at full employment, I mean, there's always going to be some employment, but statistically, when we're at full employment, is in the 4.2% range. Being below 4 was highly unusual, and observers were surprised when we got that low. So we're historically relatively quite low, and people are earning good money. So they're employed, they're earning good money, and despite the fact that they feel stressed, quite a few of them do, and sentiment is so bad, people still continue to spend money. They complain about it, but they still go out to restaurants, they're still going to stores. And as a result of that, the S&P has rallied quite nicely.
Peter, I remember after 9/11, the focus that George Bush has and was telling the American people, whatever you do, I know you're upset by this, but go spend,
Yeah,
because he realized how important consumer spending was.
exactly. So that's what I have with regard to the consumer, Richard.
Uh, the second leg of Peter's four-leg stool is is the investment side, and by that it means investment by businesses as well as by uh, other entities that it could be nonprofit spending, could be education spending, spending on plant and equipment. I think normal business cycle uh, replacement of plant and equipment would be pretty much of a flat curve going through time. But what we're doing now, which was justifies increased spending, is spending on the reestablishment of supply chains, either both nearshoring or onshoring of facilities that used to be overseas. So you're getting some investments in normal plant and equipment, and then supply chain improvement. And then on top of that, the defense spending is higher than it was and probably likely to get higher. And that is not to be before we even get to AI. And AI, the data centers, the need for utilities to continue to crank out electricity to support the data centers is probably the biggest single factor that's affecting the investment side of the C plus I plus G, and then adjusted by exports and imports. Any comments on the investment part of the cycle? I don't think it's as big as either, and clearly not as big as either the consumer spending or the government spending. But what's your sense of the investment side of the GDP?
It's absolutely booming right now, as Richard quite nicely outlined. Um, Corporate investment in plant and equipment is going through the roof right at this time. Some of it is because of policy coming out of Washington, D.C. It has been determined by Washington that we need to reinvigorate our manufacturing base. And numerous deals have been reached with companies to reshore a lot of the manufacturing that had been exported to other countries. It had been exported to other countries because typically those countries had a lot cheaper labor rates. That's no longer an excuse to do the manufacturing abroad. That will not be tolerated by Washington today. If you want to do business in the United States, if you want to sell to the American consumer, you must produce the product here in this country, or you will be faced with substantial tariffs. So that has been the force, if you will, to promote all this investment. And it is not in the millions, it's not in the tens of millions, it's not in the hundreds of millions. It's in the tens to hundreds of billions of dollars that is going to be spent in this country beginning in 2025 and ramping up through the next several years. So this is not going to go away by next Tuesday. It's going to be around for a substantial period of time. And I'm sure you all have read newspaper articles or watched the news about companies that have negotiated with Washington to avoid tariffs and to commit, in order to avoid those tariffs, to commit to building new plant and lodging new equipment, buying new equipment, lodging that equipment in the new plants in the United States. As an example, Taiwan Semiconductor, the preeminent foundry, semiconductor foundry in the world, is now up to a commitment. I think it's either 10 to 12 semiconductor plants in this country, primarily in Arizona. Now, a semiconductor plant does not get built on the cheap. A semiconductor plant could be in excess of $10 billion in cost. And it takes a while to build these things. So Taiwan Semiconductor, which is the largest manufacturer of semiconductors and is the most sophisticated manufacturer of semiconductors, is building 10 to 12 of these plants in the United States. And they're building plants to manufacture the most sophisticated semiconductors in this country, those semiconductors which are 2 nanometer semiconductors. And these are the semiconductors that are used for AI, and I can't possibly, 2 nanometers is a fraction of a hair's width. They're very, very difficult to do. So now we get to, okay, this is all going to happen. Does corporate America have the balance sheet to do this? It's all well and good to negotiate and to commit to doing something, but can we believe that this is really going to get done? Well, Christina, if you could go to chart number 3, please. On this chart, if you take a look at the top right-hand chart there, you see that blue line. This is non-financial corporate debt. And you can see that as a percent of assets, non-financial corporate debt is about 40%. So you're not highly, actually, no, it's a little bit higher. So I misread that. It's 47.8%. So again, corporate America seems to be in pretty fine balance sheet fettle here. So it looks to us as though they're going to be able to execute on their commitments to the deals they made with Washington. And then another leg of the stool about which we talk here, our four-legged stool for the U.S. economy, state and local actors, if you will, are state and local governments in a position to continue to invest. And if you look at that same chart, the top right-hand chart, you look at the bottom line in that sort of light gray line, that's state and local debt as a percent of GDP, state and local GDP, and that's at 11.7%. So they're really in quite good shape. And if you look at the bottom right-hand chart on this page, that's a state rainy day fund balance. And you can see there that those have grown quite dramatically over the last several years. So states have actually, they've been so well off through tax collections that they've collected quite a bit of money to squirrel away for a rainy day fund. So not only are they underlevered, only about 12% of their state and local GDPs is represented by debt, but also they've been saving a lot of money. So we would argue that corporate America is in fine fiscal condition. They can fulfill, they can execute on their commitments of these various deals and build all this new plant and equipment. And we would also argue that state and localities are also in good shape to provide infrastructure. That's their form of investment. So they need to provide new roads and new water systems and help out with new electrical systems. And so we think they're in good shape to do that too. So you've got the consumer who's in good shape. You've got state and local governments that are in good shape. You've got corporate America that is in good fiscal shape. Well, let's get to the fourth leg of the stool, and that fourth leg is the federal government. And there you see a very different picture. And we've talked about this in numerous past writings about our concern with regard to federal finances, excessive budget deficits, federal debt it's approaching 100% of GDP and will eclipse 100% of GDP quite shortly. And our need to finance this debt and these deficits on the open market. In other words, we know we have very little flexibility left. We've argued in the past that people are not abandoning the US dollar yet. They're not abandoning the US Treasury market yet. But we are seeing signs. We saw it in 2025, and we're still seeing signs where investment managers are making the decision to de-dollarize their assets. Heretofore, they've had the vast majority of their assets denominated in one asset, and that's the US dollar. And we think that that is going to go down. And we're already seeing evidence of that. And why is it going to go down? If you look at the dark gray line, there you see federal debt as a percent of GDP, and it's at 97.4%. That's as a fiscal year, the year end 24. It's gone up since then and will eclipse 100% quite shortly.
Peter, if I can illustrate this with a number that we talked about a little bit earlier. In 2025, the net flow from the government into the private sector was actually a negative $550 billion because they were employing quantitative tightening. There were also the tariffs, which pulled money out of the system. And there was a net drag from fiscal policy last year of close to $150 billion. So the net effect of the US government spending on the economy was actually negative last year, which resulted in a slight narrowing of some of those scary statistics. For 2026, the prognosis is absolutely the opposite. As I mentioned earlier, the cost of the value that's been attributed to the financial deregulation, I misspoke earlier, it wasn't 300 trillion, it was 200 trillion, but that's combined with the effects of the Fed balance sheet, which is the fact that they're now letting $55 billion roll over, increasing the Fed balance sheet to the tune of $340 billion this year. And then basically fiscal policy is going to contribute another $220 billion for a net $650 billion worth of stimulus to get the economy juiced up again. It's probably a coincidence that it happens to be an election year, but basically compare 26 to 25, and then there's an extra $1 trillion that's going into the economy that wasn't in there last year. So the worries that the federal spending is out of control, I think, is going to accelerate during 2026. And of course, what we've seen is very little regard on the part of either Congress, either House of Congress or the administration right now of doing much about it. I think there is a tipping point out there somewhere. I don't know where it is, but we can't keep doing this forever.
And we're, as I mentioned earlier, we're starting to see some signs of this where for about 15 years, international markets had underperformed the US market. And it got to a point a couple of years ago where people thought, well, what's the bother ever investing overseas? Because these guys will never, outpace the US market. Well, last year they did. Several markets outpaced the US market and very handily. We'll get to that a little bit later on. But also the dollar was down about 11% last year. And the dollar for the last at least 10 years has been quite strong. So there is another indication of asset managers overseas, investment managers overseas saying, we need to de-dollarize our portfolio to some extent. Again, we don't think it's a wholesale selling of the dollar and selling of treasuries. No, our markets are too broad, too deep, too liquid for that to happen. But as opposed to having 90% of one's assets in the US dollar, it could go down to 75% on its way down to 60%. And that will be meaningful. And, we don't know what the trigger is going to be, but there's going to be something out there where people lose faith in the value of US treasuries. They lose faith in the value of the US dollar, and they really start moving in another direction. So,
Do you think, I suspect that there's enough anger out there on the part of some foreign governments or foreign businesses even to start selling dollar assets at an accelerating pace. I know there's some recent developments relating to Denmark and Sweden both. Do you have any details about that?
sure, the Swedish, the main pension plan in Sweden, which had about 25, no, excuse me, about $15 billion worth of US treasuries last year, uh, fairly early in 2025, began to sell off its US treasuries and has done so. And then just yesterday, the Danish government announced that their pension plan, which had about 25 billion in US treasuries, was going to be selling off its US treasuries this year. Now, part of that's probably emotional. Um, again, I don't think that that's the big players with regard to U.S. treasuries would be Japan, Great Britain, China. Uh, I don't think they're going to all try to dump U.S. treasuries at one time. That would be deleterious to their own interests. What I think we are concerned about, however, is, as we said earlier, the US government, because of the deficits it's running and the debts that it's got, needs to sell more and more treasury bonds. We are beholden to the markets. And if we start having sloppy US Treasury auctions, that will be another indication that people are de-dollarizing their portfolios. I think that's probably the more likely route. People won't sell. They'll wait till things mature and roll off, but they're not necessarily going to be at the auctions in force, which means that interest rates will have to go up to attract buyers. So
And
that's
and
something we're going to look at.
and we've seen a little bit of that. I know the Chinese at one point had $1 trillion worth of U.S. Debt, and I think they've been gradually, again, probably through that exact methodology, as they've matured, they've looked elsewhere. But
Mhm.
that's down to between 650 and 700 billion now. So
Right.
that's a pretty substantial 35% reduction in their holdings of U.S. Treasuries.
Right.
And
Right.
simultaneous with that, the Chinese have been accumulating gold as part of their reserves that they've accumulated because they're ongoing trade surpluses. So that
The
certainly
other
is skewed.
groups, Smokey Robinson wrote My Girl, and he figures that became a big hit. So he turned around to this other lovely lady and said, you know what, I'm going to write a song for you. It's going to be called My God. Nothing in the world can take me away from my God. What was her name? Mary.
Thank you. Um, so I would expect to see a continuation of this, maybe from country to country, going forward from here. That also explains how gold did so well this year.
Okay. We investor now if you want.
So the other part of the GDP that we haven't talked about is the export import side. And the tariffs have obviously had a positive effect on the US trade deficit because our exports have declined. Our imports have probably expanded a little bit because of the reduced dollar. Do you think that's enough to have any kind of an offset to some of the dollar, the government spending issues?
I don't think so, no. I think one of the things that the tariffs have done, which has been beneficial, it's it's encouraged some of the debt rating agencies to say, well, here's an extra flow of money that's coming into government coffers, and it's making them more liquid and helping better balance the balance sheet, which is terribly unbalanced. So I believe it was S&P this year made a comment that they're keeping the AA rating on our government debt, but they moved it up from a negative outlook to at least a stable outlook. And they said it was because of the tariffs. So while that's good, that's probably about the only good thing that I can determine out of these tariffs. Um, it's it's helpful for the government's balance sheet, but it's certainly not helpful with regard to the growth of our economy.
Uh, a lot of people wonder about where all the liquidity came from during 2025 to have real estate go up in value, bonds go up in value, US stocks go up in value, um, returns on money market funds went up in value, and to a certain extent, it's been explained away a little bit by the fact that was moving out of money market funds back into the market. But there was also $1.8 trillion worth of new government debt that was issued last year. And there was a 23% increase in cash reserves during the year. I don't think we can necessarily replicate that in 2026. But do you have a sense of whether either the money supply or the velocity of money can have a positive, can continue to have a positive effect on the markets in 26.
I think the velocity of money is going to continue to have a positive impact because people no longer want to hold cash. During the epidemic, the pandemic, people wanted to have cash, and they were not interested in investing money. As a consequence, our cash balances went through the roof, and that is turning. It has turned as people have become much more comfortable getting back involved in the markets. Christina, if you could go to the next chart, chart 4. So on this chart, you can see the performance of the S&P 500 on the left-hand side since 1950. And this is taking a look at, well, when's a good time to invest? Is it, I don't want to invest now because the market's at all-time highs, and that's probably a bad time to invest money in the markets. Well, actually, it's been demonstrated that really no, it's the most important thing that one can do, as opposed to trying to time the markets, is to be invested in the markets. Much more important to have time in the markets than trying to time the markets. So the left-hand chart takes a look at the number of instances where an old-time high becomes a new floor for the stock market. And so you can see that I think it's 28 times recently, a preceding high became a floor for a next rally above. So again, it's just important to be in the markets and not try to time the markets. And on the right hand, you can see, well, what happens to the cumulative S&P 500 total returns? This is from January of 1988 through December of 2024. If you invest on any day or if you invest at a new high. And actually, it looks over like most any time period except for the shortest time periods. The green bars represent investing at a new high. And over 5 years, a 5-year period, if you invested at a new high, your cumulative return was 80.9%. And if you invested at any time during the period, just any random day, it was 74.7. And on a rolling 3-year period, investing at a new high was 46.3% versus 40% just choosing any day. So it's, people sometimes hesitate when markets have rallied so far so fast, and they say, well, it's that high, so I'm going to wait for a pullback. Either the pullback doesn't happen, or you wait for the pullback, and because the market's down, you don't pull the trigger, and then the market takes off again, and you missed your opportunity. So indeed, it may be the case that our markets have rallied too far, too fast, but it may be, and we may enter a pause. We may just sort of tread water for a period of time. And a lot of market analysts will say, well, what's happening now is, and we're presuming that corporate earnings continue to be strong, corporate cash flows continue to be strong, sales continue to be strong, and dividends are going up. If that is the business environment in which we continue to operate, because the economy is sound and growing, it could be the case that for a period of time, the market just sort of meanders. It's muddled. It doesn't go anywhere in particular. And analysts will tell you, well, this could be a period where the company's performance is growing into its stock price. The stock price got ahead of the company, and so they're just waiting for the company earnings to come along to further substantiate and support the current stock price. And it wouldn't be a bad thing, quite frankly, for us to have a period of time where we're not rocketing forward by double digits every year. This is somewhat unusual. We've been through, excuse me, I think about 3 years now, where we've had substantial stock market performance. And a lot of that performance has been focused on just a few names. We've had quite a concentration in our market. So it wouldn't be a bad thing for, number one, the performance to spread out from not just the Magnificent Seven, but to some other names. And also maybe to not have a double-digit return just simply because we need to, have the company's performance grow into its stock price.
So the performance of the market obviously is set up on a very appropriate level given all the basic economic variables. It does raise the question, could some of the um, geopolitical shocks from outside the system affect all of these positive attributes? The world leaders are gathering this week in Davos, Switzerland. And if the first 2 days are any indication, they're kind of lining up on opposite sides of the some of the major issues of the day. I know the Prime Minister of Canada gave a pretty fiery speech last night before he left Davos in advance of President Trump arriving in Davos. But he was saying that a lot of the nations are ganging up or should be ganging up to keep this to maintain some of the status quo. And a quote that he shared that I thought was sort of indicative of maybe this ganging up was, if you don't have a seat at the table, you're likely to be on the menu. And um, Mark Carney has been pretty much outspoken about the need for Canada to separate themselves from the US. Is 2026 possibly the year where some of these geopolitical forces are actually going to have an effect on the market, or is the market resilient enough, just as it was in 25, to withstand the onslaught of geopolitical chaos?
Well, it could be. I think it's just the matter of degree as to which people want to disagree. So what do I mean by that? The markets had a setback early in 2025 when there was so-called Liberation Day, because it was such a shock to the system, and really people didn't understand what all these tariffs were about. And certainly the headline numbers were very scary. Well, as we grew to learn later in the year, the headline numbers for tariffs were nowhere close to what the actual tariffs were. There were lots of exceptions. Um, there were negotiations. So what was first represented as being a 50% tariff ended up being a 10% tariff. A lot of products were exempted from the tariff. So you thought that 30% of the trade with the country was going to be subject to tariff, and it ended up being 2% of the trade with the country was going to be subject to tariff. So it was just a confusing mess. And then when people really saw, like the blind man really trying to find out the contours of the elephant, they found out it really wasn't so bad. And in fact, it was, while again, people complained about the tariffs, companies were able to manage the tariff situation, and it didn't disrupt their earnings, sales, cash flow. And so that's what allowed the markets to do so well. Now, if we have a huge blow up politically, if somebody were to attack somebody else in NATO, if these new tariffs that Mr. Trump are talking about, the headline numbers really do stick, well, that could be something. That could be a tipping point where people say, well, enough of this. This is just too confusing. I need to clear the decks. I need to seek some shelter. I need to get away from risk assets. Could happen. I don't know that it's going to happen. I'm going to presume it's not going to happen.
Scott Besson, our Treasury Secretary, had a good quote this morning. He said, "Now, everybody just take a deep breath.
Right.
Let's approach this. Let's negotiate." His Commerce Secretary, I guess Ludnick is the Commerce Secretary. He had an editorial in the Financial Times this morning telling the Europeans that there's capitalism has a new sheriff. There's a new sheriff in town. And out of one side of the administration, there's very calming influence. On the other side of the influence, there's continued flaming of the tensions. But I think we can prepare for the worst and hope for the best. Um, Talking about taking a deep breath, since it's almost exactly an hour that we've been talking, why don't we take a deep breath and ask if there are any questions from our
Good
from our
idea.
from our clients. There
Yeah,
was one, I'm
there is,
sorry.
that's okay. There is one in the chat. I'll read it to you. It says, to what extent do your figures underestimate the negative effects, both economic and political, of a K-shaped economy and individuals who, because of long-term unemployment, have stopped looking for jobs and therefore are not counted as unemployed?
You want to try that first, or you wanted to try it, Peter?
There's a recent study out that demonstrated that the upper middle class on up represented something like around 70% of consumption spending in the United States. So, and you would, as one would think about it, you would think that that does make some sense, because while there is quite a contingency that is less fortunate, put it that way, that they don't have a lot of money to spend. And so they're not going to represent a lot of the consumption spending in our economy. And the upper middle class on up, and even the middle class, if you look at their balance sheet, they have homes, or at least quite a large number of them have homes. They've got 401ks. Large segments, as we said earlier, they're employed and they're earning good money. So they are, I think, represented in the charts that we presented earlier to say that the consumer's in good shape and is in fact spending money. And so while those who are less fortunate, they're not spending, they don't have a lot of money to spend, they're not spending a lot of money. And but the statistics would suggest that they're not going to override the other economic classes, because they just don't have the wherewithal to do so.
I mean, that's reflected in the retail sales from the different segments of the economy, where the luxury retailers are doing quite well and had banner years in 2025, and the lower priced sales outlets were more struggling and didn't have the sales growth that they had in previous years. So
Right.
clearly there is a K-shaped economy, and people that are living paycheck to paycheck, they're spending all their money, but it's a small part of the national consumption patterns.
Right.
There was a client of ours posted a question in advance. Let me paraphrase it. There was some controversy about the U.S. going into Venezuela, and asking the oil companies to take pretty major stakes in rebuilding the oil infrastructure in Venezuela. And the concern of the client, because that would sort of argue for investing in the Exxon Mobils and the Chevrons of the world. But if some future administration changed the rules again, and or if the future administration in Venezuela became less cooperative with U.S. government or U.S. corporations, all that money would be again at risk. Is there an easy answer to the Venezuela situation?
I don't think so at all. There was a headline today in the second section of the Wall Street Journal: Chevron daunted by Venezuela risks. And there was another headline about Halliburton being very enthusiastic about getting back into Venezuela. You sort of said, well, I guess two things can be true at the same time. But so Chevron is the only major oil company that has operations still extant in Venezuela. They were given special dispensation to maintain their operations so that Venezuela could export a de minimis amount of crude. Halliburton is an oil service company, one of the world's great oil service companies. And it would be necessary for Halliburton and its confreres, Schlumberger or Baker Hughes, to be involved in the reopening of Venezuela. But the oil service companies, i.e. Halliburton, Baker Hughes, Schlumberger, they live off the checkbooks of the major oil companies. It's the major oil companies that are requesting them to drill wells, to lay new pipeline, to put in new generators for pump stations, et cetera, et cetera. It's out of their checkbooks, the major oil companies, the Chevrons, the Exxon Mobils of the world. It's out of their checkbooks that the funds come so that Baker and Halliburton and Schlumberger can go back in and do their work. Exxon Mobil's assets, once they get recreated, if they get recreated in Venezuela, or Chevron's, once they get created or recreated, they're there. They don't move. The reserves don't move. So if the government comes in again and expropriates all the assets that Chevron's got or Exxon's got or Conoco has got, they can't take them with them. Whereas the assets that Baker Hughes has got or Halliburton has got are basically people, and they'll move because once they build the pipelines or redrill a well, those assets belong to Chevron or Exxon Mobil. So Halliburton's enthusiastic because they're going to get paid for providing service, and service moves. Exxon Mobil or Chevron, they're in the business of owning oil assets, reserves in the ground, pipes above the ground, tanks, jack pumps, generators. They're not going to move. So if things get expropriated, they're going to get lost another time. So rightfully so, Exxon Mobil and Chevron are very concerned about the lack of law and order in Venezuela. Who are the good guys? Who are the bad guys? Who's really going to provide us security? So Darren Woods, who's the CEO of Exxon, who was invited to a meeting at the White House last week when President Trump was outlining, all the wonderful things that were going to happen in Venezuela. It's estimated that's going to take something like about $100 billion in about 10 years to bring the industry back. Darren Woods, CEO of Exxon, said, we've had our assets taken away from us twice in Venezuela. And as we look at the current situation, political, legal, security situation in Venezuela, we don't think it's a place to go right now. And he described it as uninvestable. Well, that earned the ire of the president, who said, well, maybe Exxon Mobil's not going to be invited to go down to Venezuela. I don't know about that, but it's a very dicey situation right now. Production could go up, a couple 100,000 barrels a day fairly quickly, just simply reinvigorating some of their wells. But Venezuela used to produce 3 million barrels a day, and it's now producing like 100,000 barrels a day. So to get Venezuela back on the map where it was, it's going to take a lot of money, a lot of changes in the laws and the security. And quite frankly, ExxonMobil and Chevron, I don't think are really enthusiastic about that prospect, because while our president wants oil at $50 a barrel, it's now at 60, and he wants it at 50. Venezuelan crude is a very viscous, dirty crude. It's got high sulfur content. It trades on the market. If West Texas Intermediate or Brent are trading at around 50, that's going to trade at $30 a barrel, and nobody is making money at $30 a barrel. People are barely making money at $55 a barrel, $60 a barrel. You maybe make a little bit more money, but not a lot more money. Really, where the oil people want oil to trade is in the high 70s. It's not too painful at the pump, but yet people are making good money. So I don't think that's going to happen anytime soon, unless things on the ground there change radically.
One last question of mine that may be outside your area of expertise is mineral or metals extraction from our newest target, Greenland. Apparently, it is a potentially resource-rich environment, but assuming we don't need to put boots on the ice, so to speak, is there a way for U.S. companies to get involved in any kind of extractive operations in Greenland, from what you know?
From what I have read and people I've talked to, yes, there is. In fact, the Danes are very much in favor. The Greenlanders are very much in favor of it, have opened their doors and said, sure, come ahead. If you want to invest in trying to get after these minerals, that's fine by us. But the prospect of that happening anytime soon, from talking to a couple of minerals analysts on the street, is slight to none. And that's because there's no infrastructure in Greenland. But it's been to Greenland. I have not, but from what I'm told, these settlements, if you will, where people live, are basically on the coast, and there are no roads into the interior. There are no rails into the interior. So if you want to tap those resources, you have to first build the infrastructure so that you can get to it, to deliver the mining equipment, then make it an area where people can at least live for a period of time to develop the mines. And then you need to have the infrastructure to extract those minerals and get them back to the coast. So it's going to take a while. It's going to take money. Yes, there are minerals there, but I've been told there are easier places from which to get the minerals. One of them would be Brazil, which has the second largest concentration of the so-called
The critical minerals?
critical minerals
Minerals.
that everybody's pining for. So there, you've certainly got much better infrastructure, so that you could much more, and they've got a lot of mining activity, so they're used to developing mines in Brazil. So, I mean, probably an easier deal, if you will, to come to some agreement with the Brazilian government, with whom we have a trade surplus with Brazil. So we're not working on a deficit there. So
Christina, are there any other questions?
There are not any in the chat. Just want to remind people, if you do want to verbally ask a question, you can just go down to the bottom of your screen under the React button. And then there is a little hand button that will put you in the queue. We'll give you just a second if anybody has any other questions. Or you can type it into the chat box. That'll work too.
I'd like to say in advance to thank everybody for participating today. We've made this a quarterly event for the last about year and a half. On occasion, we've had guest speakers. I saw that Bill Garrow was on the call. And as a matter of fact, I think, Bill, that was your question. Bill was one of our guest speakers. Raymond Burkhart was one of our guest speakers. And hopefully we'll have some in the future as well. But in the meantime, your team of Peter Havens and Richard May are standing ready to present on a quarterly basis within the first couple of weeks of each first month of the next new quarter. So April will be your next call. Peter, any concluding remarks?
Not for me, Richard. Thank you very much for emceeing this.
Absolutely. And thanks for everybody's participation.
Thank you all very much for attending.
Thank you.